Welcome to the 20th lecture of Economics and Management. In today's lecture, we will talk about master budget. So, budget is basically a quantitative expression of the management plans. Whatever management is going to make a plan for future or for the current year, it will get represented into a quantitative manner. Now, master budget summarizes the plan activities of all subunits of an organization. It contains sales, production, distribution, and finance of all subunits. It quantifies target of sales, purchases, production, net income, cash position, and other management activities. It is coordinated set of detailed financial schedule and statements. It includes forecast of sales, expenses, cash receipt, disbursement, and balance sheet. Now there are types of budget. First is strategic plan, second is long range plan, third is master budget, and fourth is rolling budget. So in strategic plan, it does not have any specific period for which we are going to make a plan. It sets goals and objectives of the organization. For example, whenever we will talk about the country, we will set a goal that, let's say, we have to make literacy rate up to 90%. So this is a goal, but if we are not specifying any plan period like in 10 years or in 20 years, so without specifying a period when we are setting goals and objectives of the organization, that is known as a strategic plan. It does not produce forecasted financial statements. Now next is long range plan. So in long range plan, there are specific years, like this plan is made up of 5 to 10 years, and it is normally coordinated with the capital budget. So uh, the 5 year plan that we are making for our country is an example of long range plan. We are making plan, or we are putting budget for next 5 years, and it is normally coordinated with the capital budget. So budget or some amount of money is get allocated to every department for next 5 years, and the goals are set accordingly. Next is master budget. Master budget usually plan for period of 1 year, essentially the first year of the long range plan. So the first year of the long range plan is known as the master budget. In this case, individual manager may also make task oriented budget. The next is rolling budget. In rolling budget, the budget is put forth for the 1 year, but whenever that 1 year gets completed, one next month will get added into that budget. So the month just ended is dropped and one month in the future is added. So these are examples of types of budgets based on the time span. Now components of master budget for non-manufacturing units. So there are basically two types or two parts into it. First is operating expenses budget and second is financial budget. So in operating expenses budget, first they will put sales budget. After putting sales budget, like this much sales will get incurred into next 1 year, then according to that they will write a purchase budget or they will make a purchase budget. On the basis of that, they will make cost of goods sales budget, so that will comes under expenses budget. So whenever we are having operating expenses budget, on the basis of that they will made financial budget, in which the first they will have budgeted income statement. In that they will have cash budget and budgeted balance sheet and the capital budget. So capital budget will have cash budget and then budgeted balance sheet at the end. So these are components of the master budget for non-manufacturing units. Then components of master budget. First is sales budget, right? That comes under non-manufacturing unit. But in manufacturing budget, there are sub points. First is production budget, direct material usage and purchase budget, direct labor budget, overhead budget, cost of goods manufactured and sold budget, budgeted income statement, cash budget, and budgeted balance sheet. So these are the components of master budget. So let's take one problem of which we are going to make a budget plan. Let's say the ABC company is a retailer of wide variety of household items. It is trying to develop a budget for the first time. So this company is trying to make budget for the first time. Plan horizon time is 2 months and the company is making budget only for 2 months, April and May. So 1 April to 31st May. The closing balance sheet for the fiscal year just ended is given, and whatever information for the closing year uh, we are having is given in the balance sheet. So these are the information that we are having with us. All assets are all assets values are in rupees. So the current assets are cash is 10,000, account receivable which will be net into 0.4% of March sales of 40,000, that is written in bracket, which is 16,000. Merchandise inventory, that is 20,000 plus 0.8 into 70% of April sales of 50,000, that is 48,000. Unexpired insurance is 18,000, 1,800. So the total, that is 10,000 plus 16,000 plus 48,000 plus 1,800 gives you 75,800. Plant assets are equipment, fixture, and other accumulated depreciation. So first equipment is 37,000, accumulated depreciation is 12,800. So depreciation is in negative, that's why it is written in bracket. So 37,000 minus 12,800, which will be 24,200, and the total assets will be 75,800 plus 24,200, that is 1 lakh. Now liabilities and owner's equity, that is all in rupees. This information is also with us. So current liabilities are account payable, that is 50% of March purchase of 33,600, which is given, which is equal to 16,800. Accrued wages and commission payable, that is 1,200 plus 3,000, which is 4,250, and the total 16,800 plus 4,250 equals to 21,050. Owner's equity is 78,950. So the total liabilities and owner's equity is 1 lakh, that is 21,050 plus 78,950, that is 1 lakh. Now sales in March were 40,000. So we have to make budget for April and May, but information of March is given. So sales in March were 40,000 and monthly sales forecast are given. So monthly sales forecast are given for April, May, June, July, August, that is of 5 months, but we are going to write budget of only 2 months, that is April and May, for the sake of simplicity. We can write it for April, May, June, July, August, all the months. So forecasted sales for April is 50,000 rupees. For May it is 80,000 rupees. For June it is 60,000 rupees. For July it is 50,000 rupees, and for August it is 40,000 rupees. So these are the forecasted sales for April, May, June, July, August months. Now again there are few assumptions. The sales manager expects 60% of the sales to be in cash and 40% of on credit, which will be collected in the month following the sales. Means if there is a sale of 10,000 in the current month, then 60% they will sell on the cash and 40% on the credit, and that remaining 40% that person will pay into the next month. At the end of any month, the company wants a basic inventory of rupees 20,000 plus 80% of the cost of goods sold in the following month. The cost of merchandise sold average 70% of the sales. The purchase terms available to the company are net for 30 days. Each month's purchase are paid as follows. So the whatever purchase they are going to make, they are going to purchase it for 30 days, and they will pay in the form, they will pay 50% during the month, that month whatever purchase they are going to made, they will made it for 30 days, and whenever they will do the payment, they will pay 50% during that month, and they will pay 50% during the next month. Wages and commission are paid semi monthly, half a month after they are earned, and they are divided into two portions. Monthly fixed wages are 2500 and commissions equal to 15% of the sale. A used delivery truck will be purchased for rupees 3000 cash in April. So whatever truck they are going to use for delivery, they will purchase, instead of purchase, they will rent it for rupees 3000 in April, and they will pay it for in a cash. Other monthly expenses are given. So the miscellaneous expenditure is 5% of sales paid as incurred, means they will pay at the same time. Rent 2000 rupees paid as per incurred, that is they will pay it in cash. Insurance rupees 200 expiration per month, and depreciation, in this depreciation depreciation is also incurred, so it is rupees 500. Now the company wants a minimum cash balance of rupees 10,000 at the end of each month. Money can be borrowed or repaid in multiplies of rupees 1000, and interest rate is 12% per annum. So they can borrow a money or repaid in the multiple of 1000, and the interest rate for it will be 12% per annum. Now prepare the following detailed schedules. First we have to make budget for cash collection from customers, purchase budget, disbursement from purchases, operating expense budget, disbursement for operating expenses. So let's start with the sales budget. What information we are having about it? Whatever sale we are going to do, or whatever sale forecasted we are having for the particular month, 40% money we are going to give as a cash, sorry, 40% we are going to give as a credit, means we will pay 40% money into the next month, and 60% as a cash, so 60% we will pay in the form of cash in the same month. So this is known as a schedule A and sales budget. So March, April, May, April and May for which we have to put a budget, and March is the previous month information that we are going to use. So credit sales 40%. For March it is for 40%. The information of March is given. So for March the forecasted value of budget is mm, for March it is given April 50,000 and May 80,000. For March it is 40,000. For April it is 50,000, and for May it is 80,000. So let's see. For March it is 40,000. So 40% of 40,000, that is 16,000. 40% of April 50,000, that is 20,000, and 40% of May which is given, that will be 32,000. And for cash sales also, the given forecasted value, and it's 60% for March, it's 60% for April, and it's 60% of May. So that is 24,000, 30,000, and 48,000. So in total, 40% for March, 40% of 40,000, and 60% of 24,000. For April, 40% of 50,000 and 60% of 50,000. And for May, 40% of 80,000 and 60% of 48,000. So this is schedule A, that is sales budget. Now cash collection. It is not a cash budget, it is a cash collection that we are going to make. What assumption we are having? Information is given in previous slides. Cash is collected for 100% of last month's credit, right? So for March there is nothing, but in case of look at the sales budget, the credit sales is 40%, that is 16% of March we are going to get into April month, right? And 40% of April we are going to have it in a May month. So 30,000, that is cash sales of April month, plus 16,000, that is credit sale of the March. So it will be total 46,000, and 48,000, that is cash sales of May plus credit sales of April, that is 20,000. So 48,000 plus 20,000, it will be 68,000. So total collection for April is 46,000 and for May it is 68,000. Now purchase budget. So assumptions are, first assumption is budgeted purchase equal to desired end inventory plus cost of goods sales minus beginning inventory. Assumption 2 is that desired end inventory equals to rupees 20,000 plus 80% of cost of goods sales in the following month. And assumption 3 is that cost of goods sales equal to 70% of sales. So all this information is given into the previous slide in the problem statement itself. So let's talk about the third assumption. Cost of goods sales equal to 70% of sales. So sales of March is 40,000. So 70% of 40,000 is 28,000. Sales of April is 50,000, that is given. So 70% of 50,000 is 35,000, and sales of May is 80,000. So 70% of 80,000 is 56,000. Now desired end inventory is rupees 20,000 plus 80% of cost of goods sales in the following month. So cost of goods sales in the March is 28,000, and 80% of 28,000 plus 20,000 is 48,000, right? Now 20,000 plus cost of goods sales of the April into 80%. So 80% of 35,000. So that will be 80% of 56,000 following month means next month. So 64,800, and likewise for May 53,600. Now total quantity needed, right? Total quantity needed is 28,000 per 48,000, so 76,000. 35,000 plus 64,000, 99,800 plus 56,000 plus 53,000, 1,09,600. Now beginning inventory is calculated as 42,400, 48,000, and 64,800. So beginning inventory of May is the inventory of April, that is 46,000. Desired end inventory of April, so 46,000, 64,800. The beginning inventory of April is end inventory of the March, so that is 48,000, and the beginning inventory of March is end inventory of the previous month. Now purchase is calculated as desired end inventory. Desired end inventory is 48,000 plus cost of goods sales, that is 28,000, minus beginning inventory, that is 42,400. So that will be 33,600. So putting all the values into the assumption 1, you will get for April it is 51,800, for May it is 44,800. Now disbursement for purchases. So assumption is 50% of the disbursement during the month and 50% during the next month. So 50% of last month purchase, it is denoted as schedule D. 50% of last month purchase, 50% of this month purchase. So for April it is 16,800. So purchase is given here for April 51,800, and for May it is 44,800. So 50% of it for April and 50% of it for May. So total purchase disbursement will be 16,800 plus 25,900. So that will be 42,700, and 25,900 plus 22,400, that will be 48,300. So this is disbursement for the purchase. Now operating expense budget. So assumptions are wages rupees 2,500, commission 15% of the sales, miscellaneous expenses 5% of the sale, rent is 2,000, insurance rupees 200, and depreciation including truck is rupees 500. This information is also given. So it is a schedule E, operating expense budget. So wages for March, April and May, these are constant, 2,500, 2,500 and 2,500. Commission is 15% of the sales. So sales for March is 40,000. So 15% of 40,000, 15% of 40,000 is 600. For April it is 50,000. So 16% of 50,000 it is 7,500, and 15% of I think 80,000. So it is 12,000. Now total wages and commission. So total wages and commission will be wages plus commission, that is 2,500 plus 6,000. So that is 8,500 for March. 2,500 plus 7,500 equals to 10,000 for April, and 2,500 plus 12,000 equals to 14,500 for May. Now miscellaneous expenses are 5% of the sale. So for April month it is 5% of the 50,000, that is 2,500, and 5% of the sales of May, that is 4,000. Rent is 2,000 for both the months. Insurance is also 2,000 for both the months. Sorry, 200 for both the months. And depreciation is 500 including truck. So the total operating expense of the um, of April and May month is 2,500 plus 7,500 plus 10,000 for 2 plus 2,500 plus 2,000 plus 200 plus 500 equals to 15,200 for April, and for May it is 2,500 plus 12,000 plus 14,500 plus 4,000 plus 2,000 plus 200 plus 500 equals to 21,000. Now disbursement for operating expenses. So assumption is given 50% of last month's and 50% of the month's wages and commissions are paid in current month. So this is schedule F. Disbursement for operating expenses, wages and commissions, 50% of last month's purchase. So we know what is purchase. So total purchase and disbursement is given here, and purchases are given here. So for March, April, May we are having all purchases, and so 50% of disbursements during this month and 50% during the next month. So schedule F we are having here. So 50% of last month's and 50% of this month's wages and commissions are paid in the current month. So we know purchases of April and May. So we can calculate 50% of it. That will be 4,250 and 5,000. 50% of this month's purchase. We know this month purchase also from the last slide. So it will be 5,000 plus 7,000, 5,000 for April and 7,250 for May. Total wages and commission, that also we know, that are 9,250 for April and 12,250 for May. Miscellaneous expenses also we know. So these are 2,500 and 4,000. Rent is constant, 2,000. So total disbursement of April will be 4,250 plus 5,000 plus 9,250 plus 2,500 plus 2,000, that will be 13,750. And for May it will be 5,000 plus 7,250 plus 12,250 plus 4,000 plus 2,000, that will be 18,250. So this is the total disbursement of operating expenses budget we have put. So all the points we have covered. So let me show you what we have to calculated, what we need to calculate. We have to make a cash collection from customers per purchase budget that we have put, disbursement from purchases that we have done, operating expense budget that we have written, and disbursement for operating expenses. So we have covered all this point from this sales budget, then purchase budget, then disbursement and purchase, operating expenses budget, disbursement for operating expenses. So for today we will stop here. Thank you so much.